Hi, I'm Jeff McLean, CEO at Solidarity Wealth. In today's video, I highlight the problem of trying to time the stock market. Although it is appealing in theory, the reality of trying to time the stock market is much less promising. Now, I'll admit, it is super tempting. Every investor, including me, has that one example where they successfully timed the market just perfectly. Now, unfortunately, though, that's not the case, right? And I've seen the negative long-term consequences firsthand over and over again for those who've tried to time the market. So beyond being an inherently flawed approach, a timing the market investment strategy risks losing out on the best days in the market, which can be devastating over time. So let's go over everything that you need to know about this strategy. Now, to be clear, timing the market means buying low, selling high, which sounds awesome. And there are two common reasons why people try to time the market. The first one is obvious: to get rich quickly. If you can time it just right, the results will be amazing. The second reason comes from the emotional investor, those who get scared in or out of the market. Whatever the reason, both investors think they can outsmart the market. And in theory, their stated goals make a lot of sense. Of course, everyone wants to buy at just the exact low point and sell at the exact high point in the market once it's reached its peak. It's a great idea. However, the biggest problem with the strategy of trying to time the market is you have to be correct twice. You have to be right once at timing it just right when you get in, and you also have to be correct timing it when to get out. It's the equivalent of winning the lottery and then taking all your winnings and putting them right back into the lottery a second time to try to win even bigger. It's very hard. And even the casino bosses in Las Vegas probably would not recommend that approach. It's highly unlikely that you're going to come out ahead. What usually happens, unfortunately, with an emotional investor is that they roll the dice and they get in too late, well after the market has bottomed, and then they get out well too early before the market has peaked. That means that you miss out on stock market rallies that happen truly after a market bottoms, and you miss out on the late stage tail end of stock market growth as it's on a winning streak for a long period of time. It's a lose-lose strategy for investing in the market. To put some real numbers behind this, take a look at the graph on the screen that illustrates the outcome of missing the best days in the market. You can see in the graph that an investor who missed the 10 best days in the market between 1992 and 2021 would have earned 54% less than someone who is fully invested and did nothing other than stay invested during that same time period. 54% less. Missing just a few of the market's best days is a significant downside to trying to time the stock market. The smarter, the better approach is to consult a professional wealth advisor who can guide you on long-term investment strategies, not products, but actual investment strategies like the one that our team at Solidarity Wealth here with our proprietary public market investment strategies specialize in. So if you're interested, give us a call, send us an email, reach out. We'd love to talk about how we view the markets in a better, more consistent way of staying invested and having growth.